My name's Ned Bell. I'm the Chief Investment Officer for Bell Asset Management, and this is the Q3 2020 update for the Bell Global Equities Fund platform class. So first of all, touch on performance. It's obviously been a really tough period for markets the last 12 months. In terms of how the fund has performed, over the last 12-month period, the fund is down 10.8%. So it's marginally lagged the MSCI World Index by about 1%. And that's against the backdrop of obviously like you've seen huge economic sort of upheaval, lots of market volatility, and we've also had a few issues that have sort of worked for and against the returns in the last sort of 12-month period. More specifically, as a quality manager, the quality factor has actually lagged. It's lagged by a couple of percent. A bit over 2% over the last 12-month period, so that's worked against us a little bit. The other factors that have worked probably against us in the last 12 months have been our lack of exposure to energy. So energy has been really the only sector that's performed well in 12 months. So that alone has cost us 1.8% relative performance. So again, the energy sector as a whole is up 38% over 12 months against the market being down about 10. So huge outperformance, lack of exposure hurt. Our marginal overweight in consumer discretionary stocks and IT stocks also hurt us a little bit by about 0.4%, and being a bit overweight in the small mid-cap names also lagged. So the sector as a whole, the SMID sector lagged by a touch under 5%, so that worked against us. On the positive side, there were some positives that offset a lot of those negatives. The first one was the lack of exposure to the big growth stocks that we all know well. So clearly those big growth stocks we know well have lagged pretty materially. The growth factors lagged by about 8% over 12 months. And so while it was painful being underweight those names for the 3-year period up to September last year, it's definitely come back in our favour more recently. Being overweight in sectors like healthcare and consumer staples also really helped by about 80 basis points all up. And the other common theme when we look at the names that have done well for us, one of the really common themes is that they were all we thought they were very undervalued this time last year. So towards the end of the first half of last year, we were taking profit and growth and really moving in towards putting more capital into names we thought were undervalued and underappreciated in a market that was ripping high, led by growth stocks. And not only down, we had about 20 names. They're up by more than 10% in the last 12 months against a market down by 10. So effectively 20 names that outperformed by 20% or more. And it was really a combination of large cap names and small mid cap names. But some of the ones you know well would be names like United Health, PepsiCo, Amgen, Costco, Novo Nordisk, Johnson & Johnson, Marsh, McLennan, McDonald's, all in that large cap space. And even in the small mid-cap space where there's been lots of volatility, the likes of Arista, Booz Allen Hamilton, Cerner, AmerisourceBergen, Jack Henry, Kroger, Hershey, and a few others, really help the portfolio. When it comes to, positioning, and we get asked a lot, how's the portfolio positioned for what's obviously a very turbulent environment? Probably one of the most important metrics is looking at the portfolio characteristics, because we're very much of the view that in an environment that's dictated or driven by consistently high levels of inflation and rising interest rates, the pricing power that companies have and their leverage are two of the most important factors that will drive performance. So the portfolio at the moment, for example, the average return on equity is 26% versus about 15% for the benchmark. And the net debt to EBITDA is 0.8 times versus 1.3 for the benchmark. So in other words, the portfolio has better pricing power, more profitable, and less debt. So that positions these companies really well for what's going to be a fairly turbulent period for the next year or two. And then really importantly from a valuation perspective, the valuation risk in the portfolio we don't really have much valuation risk. The PE of the portfolio is a touch over 17 times earnings. So we haven't let ourselves get exposed to the really expensive end of the market. So maintaining that balance between quality and valuation is really important. We think that holds us in really good stead. Furthermore, from a sector perspective, the biggest overweights we've got now are in healthcare, consumer discretionary and IT. And one of the main reasons we are overweight in particularly discretionary IT is predicated on the view that they're very undervalued at this point. So a lot of those names have been very, very weak. We think to a large degree they've overshot on the downside. They now represent really, really strong value. In terms of the underweights, we tend to be underweight sectors like financials, energy, utilities, and then also from a market cap perspective, we're overweight in small mid-cap names. So at the moment, we've got about 45% of the portfolio in small mid-cap names, for the main reason being that they are very, very inexpensive. So they're currently trading on a PE of just under 13 times earnings. That is the cheapest they've been in over 10 years. So they are very, very cheap, and having that valuation buffer is really important in what's obviously been a pretty turbulent period. From a trade activity perspective, since 30 June, we've actually been pretty quiet. The bulk of the activity has been in adding and trimming existing positions with a focus on adding into weakness. So again, a lot of our names have got very oversold, we think. They're now at a point where they're reflecting sort of a very, very bearish scenario. And while there's no question there's earnings risk in markets, there's volatility, you need to be able to, as long-term investors, we need to be able to look through what is arguably going to be a difficult 12 months and look at this as being a great opportunity to pick up great companies when they're temporarily out of favour. In terms of the positions we have traded, we've exited a couple of positions in Medicis, SimCorp, Union Pacific, and we started a position in Procter & Gamble. And that's since 30 June. So again, we haven't done a lot by way of wholesale change. It's really been about recognising the fact the best value is actually in names that are already in the portfolio. So with that, I'd wrap up by saying we still feel very confident in the way the portfolio is positioned. We think we're holding up pretty well against what's obviously a very, very turbulent environment. We actually love volatility. I know it causes investors some pain, but it does demonstrate that this is when we get the best buying opportunities. This is when you get the opportunities to buy companies when they're very, very inexpensive. And if you can look through the next 1, 2, 3 years, this is when the seeds of alpha are really sown. And that's how we think about things now. So with that, thanks very much for listening and look forward to seeing you on the next update.